Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's edition of the class, as you know by now, we're actually going to be talking about day trading versus swing trading. Which one is better, okay? So, I know if you've been a regular ITU Forex class attendee, by now you probably know what the answer is because just to let it out of the bag, you know that I'm going to tell you that whichever trading uh, methodology you choose to use or trading style, it actually all boils down to your lifestyle, your personality, and all of those things. Okay, so day trading might be good for one trader, and then it might not be fit for the other trader. Okay, so it all depends on you. And my job here is to outline the pros and cons of both of these trading styles, and then you'd actually have to reflect on your circumstances, okay? And then you're going to look at which one is going to favor you more, and then you pick that, okay? But my job here is to show you the pros and cons of both of them. I personally am a swing trader. I've been a swing trader for as much as I can remember. And part of the reason why I made that decision to adopt swing trading as a trading style was because when I first started trading, the whole idea was freedom, okay? Not only financial freedom, but also time freedom. So when I began trading, I actually wanted to be able to make money from trading without having to sacrifice my time, to trade all day or all of those type of things, or basically turn trading into another full-time job, okay? So there are people who get into trading for that freedom, but then even if they are able to get that financial freedom, they don't get their time freedom back. So whatever money they have to make from trading, they have to toil for that by sitting in front of their screens for hours on end in a day to actually make that money. So at the end of the day, even if they do make money from trading, they actually don't get enough time to enjoy it with their family and friends or all of that. So my personal preference, one of the reasons why I gravitated towards swing trading was because of the time freedom. Not only financial freedom, but time freedom as well. Because swing trading is the type of trading methodology where you're actually trading, let me say the median time frames, because you're not trading time frames as high as the weekly or the daily or the monthly, where you're going to hold trades for, weeks to months or whatever the case might be. With swing trading, most times you're actually going to be maybe trading off of the 1 hour time frame or 2 hour time frame, or, at most 3 or 4 hour time frames. Okay. And then most of the times you're only going to be holding those trading positions for, let's say, a couple of hours to a couple of weeks, and at most a couple of weeks. Okay. But with day trading, the opposite of swing trading, you're going to be trading the much lower time frames. It's not uncommon for you to see a day trader trading the 5 minutes or the 15 minutes time frames. Anything lower than that, maybe the 5 minutes or plus the 1 minute time frame, might be a scalper, okay? But for a day trader, it's not uncommon for them to trade the 5 minutes or the 15 minutes time frame. And the reason is because day trading as a style of trading involves you having to open a trade at the beginning of a trading day, and then making sure that at the end of that trading day you are flat, which is trading speak for you have no open trading positions. So by definition, a day trader cannot or should not have trades overnight. Have open trades overnight. So if a day trader opens a trade today, whatever session he opens that trade, by the end of that trading day, he should make sure that that trading position, whether it be in profit or whether it be in a loss, it is closed. Okay? So that's the thing about day trading. But with swing trading, it's not that rigid. A swing trader can open a trade and have that trade last for a couple of days. In fact, some trades that I hold most times last over the weekends. So I might open a trade within the trading week, maybe on Monday, Tuesday, Wednesday, Thursday, whatever the case might be. But then I could have that trade last long enough for me to go to hold it up until the next week, or even a couple of weeks at a time. It's not uncommon for swing trading to give you those type of trading opportunities. So again, we're going to be talking about the pros and cons of each of these trading styles, and then you are going to have to do the due diligence to analyze your personality, your lifestyle, and your circumstances, your situation, and then look at which particular style fits you more, fits you like a glove, okay? And then you choose that and ride with it, okay? So without any further ado, let's dive right into it, okay? Okay, so moving on. First things first, you can see that the advantages, the pros that we have of day trading, just like I told you, is that profits or losses are relatively quick. The results from your trades are relatively quick. And the reason is because if you're trading the lower time frames, obviously, let me show you an example, okay? Because just telling you about it might be hard to picture, okay? So here's an example, a typical example. We're on the daily time frame of the USD JPY currency pair. So regardless of the trading strategy you use or whatever the case might be, let's assume that you identified a trade setup here, a trade setup for going short in and around here. So again, regardless of the trading strategy you use, this is just an example, okay? So assuming you identified this short trade setup and you wanted to take this trade, and then you took this trade, you shorted here with your stop loss being above this resistance area. Let me turn off this magnet so that I can freely move this. Okay, so you actually placed the stop loss for this trading position in and around here. And let's say you're trading like a professional. You're using proper risk management, never risking more than 1% of your trading account's capital per trade. And you're trading aiming for positive risk to reward ratios. For example, when I say positive risk to reward ratio, when you're risking 1, you are aiming to make a profit which is more than 1. So if you're risking 1% of your account's capital or 100 pips, which results in 1% of your account's capital, you are aiming to make at least 200 pips in profits. That's like 2% of your trading account's capital or higher. So it might be 1:2. This is 1:2, the example I just gave you, or it could be even 1:3. So for this particular example, let's use a risk to reward ratio of 1:4, just to illustrate the point, okay? So in this case, assuming you took this trade here, okay, and then this was your profit target way down here, okay, bear in mind that even though this trade ended up hitting your profit target, it would have easily hit your stop loss too. It doesn't really matter in trading. Obviously, by now you know that losses are part of trading. But what I want you to bear in mind is the fact that when I pick this ruler tool here and I measure from the moment we entered into this trade right up until the time when we exited out of this trade, when it hit our profit target, since we are trading on the daily time frame, this trade actually took 86 days. That's 86 trading days to play out. Okay, so even if you're practicing proper risk management, even if you're doing all of the things you're supposed to do, assuming you're only trading this currency pair and nothing else, okay, and then you took this trade and it had to last about 86 trading days because you have weekends part of this which are not counted for here because obviously there are no candles on the weekends. This would have been a trade that would have lasted 86 days, almost 3 good months. So even though making, a 4% profit when you're risking 1%, aiming for a 1:4, obviously when price hits your profit target, you'll be making 4%. Even though you made a 4% profit from this trading position, yes, but it took too long. If this is the only currency pair you're trading, this would mean that it took you almost 4 months to hold on to this trade and to get the profits. And this could have easily went south because with swing trading, what I want you to also bear in mind is that you might have entered the trade here, and assuming you're not using any risk management, trade management technique, where, for example, if you enter the trade and the trade reaches 1:2 or 1:1, you move your stop loss to break even, all of those things. Let's say you're just using a simple set and forget trading methodology. So you enter the trade, place your stop loss and place your profit target, and you do nothing else. You just sit and wait for and wait for the markets to either hit your profit target or your stop loss. Then it's not uncommon for price to come all the way down here, very close to your profit target, only for it to just go all the way up and hit your stop loss. So you would have waited all of these days, saw these profits, for a long portion of the time, and then ended up hitting your profit target. This is not uncommon. It happens in trading. These things happen in trading. Okay? So one of the things about swing trading, one of the pros of day trading over swing trading is the fact that whether you are taking a loss or you're taking a profit, because you're trading on the lower time frames and it's day trading, your losses or your profits are relatively quick. So to contrast this example with what happens on the lower time frames, this is the daily time frame like I kept telling you, but let's do something like go back to the 5 minutes time frame and look for a trade setup just to show you an example. So let's say the same thing happened here. You identified a trade setup This was based on the 5 minutes chart. So whatever again, it doesn't matter what trading strategy you're using here. This is just to illustrate my point. Okay. So let's assume you identified the trade setup here, and this is a short trade setup. And then after you identified this setup, you took a short trading position in and around here. Okay, after the formation of this bearish engulfing candlestick, place your stop loss right above this resistance area, and just like we did on the daily time frame, on the 5 minutes time frame, you're also doing the same thing. You're aiming for a profit of 1:4 this to the reward ratio. But just look at what happens here. When I pick the ruler tool here again, and we measure from the moment we entered into the trade up until the moment where price hit our profit target, it would have only taken this trade 10 hours to hit your profit target. So this would have been a trade that would have closed in profit in your favor much quicker than the other example which I showed you on the daily time frame, using the daily time frame as an example. Obviously, there are traders who are swing traders who are not trading time frames which are as high as the daily time frame, maybe something like the 4-hour or the 1-hour time frame. But this is just so you can understand my point, so you can understand the illustration I'm making. We'll get into that, but this is one of the reasons, this is one of the arguments for pro day trading. Traders who have the time, and this is why I keep making this point, okay? The traders who have the time, let's say you're somebody who is, you're not a business owner, you don't have a day job or whatever. Let's say you're an entrepreneur, and being in front of your charts is nothing. You could do it in front of the you could just open your charts while you're waiting for your trade setups, you're watching a movie or you're doing something at home. It doesn't take much of your time. You're just sitting in front of the charts, and it's no inconvenience for you because you don't have any job to go to. Maybe you're the boss or all of those things, okay? So day trading might be for you in that situation. But for somebody who is, for example, a person who has a full-time job, or somebody who is a student, for example, he has to go to lectures, or all of those situations, that person doesn't have the time to sit in front of his computer to look for trade setup like a day trader would. Okay, so again, this is the pros and cons. This is the first one. Okay, now let's talk about the second one, which is obviously the fact that with day trading, okay, let me quickly show you this. With day trading, you have no overnight risk. To explain this, to further drive home this point, there are traders, especially if traders who are just starting out, okay, traders who have traded the market for some time now, if you've traded for a little bit of time and you've taken trades on demo accounts or whatever the case might be, I'm pretty sure you know that when you have an open trading position, or even if you don't have an open trading position, most of the times when it's weekends, you're going to see the market open with a gap just like you're seeing here. So the market closed here, but then due to things that could happen over the weekend when the market is not actively moving, when the market does open on Sunday or whatever the case might be, you're going to see this gap. And this is not only limited to weekends when the markets close and when the markets open. Most of the times when during the overnight session, there are times when you could just wake up to a very, very big move or spike due to some new release in other parts of the world or whatever the case might be. So for a swing trader is exposed to these types of risk. But a day trader is not as much exposed to this risk because by definition, a day trader does not hold his trades overnight, just like we talked about a couple of moments ago, okay? A day trader, most of the times, he opens his trades during the trading day and then closes that trade during the trading day. He doesn't leave any of his trades to last overnight, okay? And then last but not least, again, like we said it suits, a day trader suits fast decision makers who enjoy active trading. This simply means that if you're somebody who loves the adrenaline rush of, just opening a trade with a high lot size and seeing it swing past your profit target or quickly hit your stop loss, and that doesn't really bother you, day trading might be for you. Go for it. But the cons of day trading is the fact that it's very time consuming. It requires your full attention. So let me give you an example. There's a guy I've been following, okay, a couple of the social media channels, because he's a trader also. He's a day trader, and he gave a example that actually simplifies this completely. He says he was waiting for a trade setup on his charts, okay, and then the setup didn't quite finish forming, and so he decided to just get up and go make himself some coffee and whatever the case might be, okay. So he made himself coffee, and when he got back to his chart, the setup had already formed. Because it's day trading, it's very fast paced. The setup has formed, and it had even gone away without him. And as a professional trader, he couldn't rush the market. He couldn't follow the market because he had ideal entries where he wanted to enter into the market with his trade. So that trade left without him. And that could have been maybe a winning trade, and maybe he could have been in a losing streak. So that one trade would have made up for the losses that he took. But because day trading is so fast-paced, and he was just away from the charts when he needed to be in front of the charts because he's trading manually, guess what happened? He missed out on that trade setup. And you don't want to be missing out on trade setups in this kind of situations, okay? Because the trade you miss might just be the trade which will cover all of your losses, okay? So another thing is that day trading is quite emotionally intense. It has a high tolerance. You have to have a high tolerance of stress for you to thrive in a day trading environment. And the reason is simply because, again, when you take a trade, when it's a day trading trade, just like I showed you with this example, most times the trades are either going to play out quickly or they are not. And as a result of this, since your entry is very close to your stop loss relatively to the higher time frames, what you're going to find is that obviously when you take those trades, you're going to take them with huge position sizes. And so slippage and the spreads and the commissions and all of that will affect you more than it will affect somebody who is trading based on the swing trading strategy or swing trading method, because his lot sizes are very relatively wider. Okay, so this is exactly what I told you. To illustrate this point for you, let me quickly show you what this would look like, okay? On let's use my FX Book's position size calculator, okay? My FX Book, their position size calculator. To get to it, you just open it here, and then you come to FX calculators, okay? And then you look for position size calculator, okay? Let me just search for it here. My FX Book position size calculator here. So let's just go directly to it. Exactly. So let's assume you're trading with a $100,000 prop firm account. This is just an example, okay? Or to really hammer in the point, let's just say $200,000 account, okay? And you're trading the Euro USD currency pair. Your account is denominated in the United States dollar. And just like every professional trader recommends, you are actually trading with a 1% risk on that particular trade or whatever trade you take on your account. So the only difference in this situation is for a day trader, for example, going back to our example, this is the daily time frame of the USD JPY currency pair. And if you could remember, we used an example of a 1:4 risk to reward ratio trade, which we took, which hit our profit target. But in this case, just look at what we have here. When I pick the ruler tool and I say this is our entry, this is our stop loss, you notice that the distance is around 409, let's just say 410 pips. Okay, so the stop loss, the distance from our trade entry to our stop loss for this particular trade, which is a swing trading example, is actually 410 pips. So now we're going to type in that 410 pips here into this position size calculator. And the reason we're doing this is because we want the calculator to help us calculate what lot size we need to trade with on this account so that we don't end up risking more than 1% of our trading account's capital on this trade. So in this case, when I click on calculate, you can see that this tool has worked out the numbers, and it's telling us that since we are trading on a $200,000 account, the amount we are going to be risking on the trade we take is $2,000, because $2,000 is actually 1% of that $200,000 account. If we were trading based on units, which some trading platforms like TradingView obviously uses, then we need to place our trade using a 48,780 units of the base currency in this currency pair. But if we're trading based on lot sizes, just like platforms like MetaTrader require, then for this particular trade, we actually need to place this trade with a 0.49 lot size on this account so that when price eventually hits our stop loss, for example, we will not lose more than $2,000 on this trade. Now, before I move on to the day trading example, for swing traders, most of the times, swing traders know that, or not even swing traders, in general, brokers, the way they charge traders is through spreads or commissions. Some traders charge traders both spreads and commissions. Okay, so for brokers who charge based on your lots, okay, based on your commissions or whatever the case might be, that is usually based on one standard lot. So a broker might tell you that for a round turn of a trade, that's you open the trade and you close the trade, you are paying a portion of the spread when when you get into the trade and when you get out of that particular trade. So that's a round turn. So a broker could tell you that for every single lot of the Euro USD currency pair you trade, one full lot, 1.0, this is 0.49. This is not up to a full lot. This is like half a lot, okay? Barely half a lot. So for one standard lot, a broker could tell you that he's going to charge you $10, okay? Keep that in mind. And if a broker is charging you based on spreads, then the price that you're going to be getting into the market might be the bid price. But the ask price, the difference between the bid and the ask price might be, this is the reason why when you enter a trade immediately, because there's a difference between the bid and the ask price, that's the spread, you're going to see immediately you're in negative. It's also because of the charges of the broker. Now, let's assume that you are a trader who is trading based on day trading strategies, just like the 5 minutes time frame example we used. But in this case, you obviously, since you're a day trader, your stop loss is going to be way smaller than this 410 pips that you're seeing here. So for that day trader, let's just make it easy and just say the stop loss, the distance between your trade entry and your stop loss is, let's say, 30 pips on this currency pair. The risk remains the same. It's still 1%. The only difference is that because you are a day trader, your stop loss is very close to your trade entry, which is only 30 pips in this example. Now, bear in mind that this is the numbers for the swing trader. This is the lot size he needs to trade with in order to risk $2,000 on this account. Now, for the day trader, we are going to type 30 pips here and click on calculate. Now, just look at the difference. For the day trader, he needs to place his trade with a lot size of 6.67. So if we were to even round this up, it's going to be something like 6.70 or whatever the case might be. So because of this, if you were trading based on and paying your broker based on commissions, remember I told you that for a round turn of 1 Euro USD, one standard lot, it could be that each lot size that you're trading, the broker is going to charge you $10. So for 6.6 lots, it's going to be like the broker is going to charge you like $10 times 6.6, almost $67. So while a swing trader could take a trade, even though he's not going to hit his profit target earlier, even though whatever the case might be, what he's paying in the spreads and commissions is way smaller than what you as a day trader is paying, because you're paying almost 6 times that amount. And this is even using a generous 30 pips stop loss, because there are traders out there that I know who trade with just barely like 20 pips of stop loss. When you calculate this is like trading with a 10 lots. So for this particular trade, a swing trader might just be paying like, less than $10 because it's not full up to a standard loss, 0.49. But then you, as a day trader, is paying $10 times 10, which is like $100. So these are the things that a lot of traders don't tell you. When they're teaching you how to trade with their strategies or whatever, they don't tell you. And this is the reason why you don't just take a trading strategy off of the internet and go and start using it. First, let's say you find a trading strategy that resonates with you. You first need to backtest it. Then you forward-test it. You see how spread and commissions and all of those influence the trading strategy, because there are trading strategies that are profitable on paper, but when you take it to the live market, because of the influence of spreads, or slippage, or all those things, they are going to cause the strategy to not be able to make money. Maybe it will barely break even at the end of the day. So these are the type of things that you need to pay attention to. Now, we've talked about the pros and cons of day trading. What about swing trading? Obviously, you know where I'm going with this, okay? So with swing trading, the pros, number one, just like we did with day trading, the swing trading is that it's more flexible, just like I told you earlier on in the video. You need to, for a day trader, he might need to sit in front of the time. It's very time intensive. But for a swing trader, assuming you're trading based on the 4-hour time frame, you might only need to look at your chart every 4 hours when the candle closes. And if a candle closes and you don't see what you want to see, you just close the chart and go and do whatever you want to do. How many 4-hour candles form in a day? Only 6. So, you might just look at the charts like 6 times a day and place your trade. And once you're even in a trade, assuming you're trading with a set and forget trading strategy, where you place your stop loss, place your take profit, and do nothing else, just fold your hand and wait for price to either hit your profits or stop loss, profit target or stop loss. Guess what? You don't need to do anything else. So it's way easier to trade. because you don't have to, it's not time intensive, you don't have to be in front of your chart. So if you have a regular job, or you don't just have time to sit in front of the computer, it gives you very, very good moves. Another thing is, there's the opportunity for you to catch very big moves. There's a way to do this, because like I showed you, if you are using the standard way of just finding the trade on the daily time frame, for example, or the 4-hour time frame, the higher time frame, and then placing that trade based on the higher time frame for the stop loss and the take profit and everything, then it's going to mean that your profit targets are going to be very far, because your stop loss is very far also. But some traders, to reduce the stop loss and increase their profit target, what they do is they will identify a trading opportunity on the higher time frame, and then they would go to the lower time frames to refine that entry, so that they're going to risk less pips and then still aim for the profit target on the higher time frames. So let me show you an example. You see, like for this particular trade setup, which we're using as an example on the daily time frame, this is where we said we would take the trade, and this is where the stop loss would be based on the daily time frame. But maybe a proper swing trader who is using this refinement technique that I told you might decide, you know what, I'm not going to actually take this trade based on the daily time frame. I'm going to use multiple time frame analysis, so that the trade, I'm actually going to take it in a way that I'm going to reduce my stop loss using the lower time frames. Okay, so okay, let me do Control Z. This was where the setup was. So let's say that this trader actually identifies this setup on the daily time frame, but then instead of taking that trade based on the daily time frame, let's say he's a market structure trader. So obviously he saw that price was making higher highs and higher lows, obviously, but then the market structure changed. And so when he saw this change, and he saw that price now broke below this resistance after this big candle, for example, he would still decide to take the trade here. But then instead of placing his stop loss way up there, he's going to do something like bring his stop loss somewhere here. The logic is that if for whatever reason price breaks above this high, then this is no longer a setup he wants to be in. He would want to wait for price to continue, and then maybe he would look for another lower high and take that trade. So in this case, this trader has reduced his stop loss from way up here, like 410 pips, to way down here. So in this case, he has reduced his stop loss, but he's still aiming for the profit target of the higher time frame, the daily time frame. Because of this, you can see that his trade went from being a 1:4 risk to reward ratio trade to now being a trade which would have been a 1:14 risk to reward ratio trade. So if you do it this way, even if your trade is going to stay for a long time open based on swing trading, you're still going to make a huge profit, okay, increase in your profit because of this refinement, okay? So next thing, one of the next advantage of swing trading, okay, is that it actually is for traders who are patient, okay? So traders who don't want too much stress, okay? Like I told you, day trading involves, a lot of anxiety. You're taking the moves, you're doing all those things. It's very tasking. But for somebody who is more composed, who wants less stress with trading, swing trading might just be the way to go. I prefer swing trading, obviously, okay? Even though day trading could potentially offer you more profits if you know what you're doing. But I still prefer swing trading, but you could choose, okay? Now, what are the cons of swing trading? Like I told you, there are unexpected news events which could come out over the weekend or over the night. So this could potentially affect your trades, okay? And then the slippage and the spreads and all those gaps or whatever could end up causing you to lose more than you initially planned to lose, because that's just the way the game rolls, okay? And then there are also fewer trade setups. With a day trader, within a day, he might identify a trade, place the trade, and do whatever. But with a swing trader, it's not uncommon for a swing trader to go for days without identifying a trade setup. If your strategy doesn't give you a trading signal, you don't take a trade. So it's not uncommon for a swing trader to go for days or maybe even weeks without seeing a trade setup. There are much fewer trades, okay? And the stop losses, again, this is what I said, the stop losses are much larger if you are not using this refining technique. But this is also a positive, because your position sizes are going to be smaller, and so the cost that you're going to be spending on the trades you take is going to be much smaller than that of a day trader, okay? So which one is best? obviously, day trading suits traders who thrive in fast-paced markets. Traders who just, they don't mind the adrenaline rush of taking a trade, now seeing the stop loss or take profit being hit within a couple of hours or a couple of minutes. This is if this is you, swing trading is for you. Day trading is for you. But swing trading suits traders that have limited time and they prefer a calmer approach. Like I explained to you, swing trading, if you're trading based off the 4-hour time frame, you're only going to be maybe looking at the charts once in every 4 hours. Okay, and so it's a lot calmer. It's a lot easier for traders who are, short on time to use it. And the best style is the one that matches your lifestyle, your personality, and your risk tolerance, just like I told you. But also, don't forget that day trading often comes with higher commissions and higher spreads because of the way it's structured. Because since you're trading with tighter stop losses, your lot sizes are going to be bigger. As well, your commissions and spreads are also going to be bigger. Okay, so this pretty much brings us to the end of this week's edition of the class. But before we wrap up, I would quickly want to use this opportunity to let you guys know, as usual, that these trading techniques and methodologies which we talk about in the ITU Forex class are for trading styles which involve manual trading. But we also have an approach which is known as automated trading, which is designed to give you trading opportunities, and then you don't need to take those opportunities or do the risk management or anything yourself. There are robots or trading expert advisors who are going to spot the opportunities for you, take those trades for you, and then manage it properly, just like you would. In fact, much better than you would, because they are following the rules. They are not letting emotions run the show for them. Okay, so if you're interested, please reach out to us on the socials and or in the comments of this video. Let us know, and we'll be more than glad to help you, guide you to setting up everything step by step, and then taking advantage of this opportunities. Okay, so once again, thank you very much for taking time out of your busy schedule to come to the class. I seriously appreciate it, and I hope that you got immense value from the class. I look forward to seeing you guys in next week's edition of the class. Once again, thank you very much, and God bless you. Have a wonderful rest of your trading week, and cheers.